Hello, everyone. This is Tim Leveroni. I want to thank everyone listening to this market update call. Our goal is to educate you on the market environment and share perspectives from some of the investment managers we recommend. Shortly, I will introduce our speaker, Ryan Dietrich. He will present LPL Financial's outlook on the current markets. This call is being recorded today. There will be no questions during the call. If anyone has any questions, please call or email us. As Vice President, Senior Market Strategist, Ryan Dietrich is a member of LPL Financial's Research Tactical Asset Allocation Committee, responsible for directly impacting the portfolio decision-making process, as well as a member of the Market Insight team, developing and articulating equity and general market strategy. In this role, he is a frequent presenter to clients, industry peers, and the national media on emerging and developing market trends. Prior to joining LPL Financial, Mr. Dietrich was building his market knowledge and solid analytical skills. He was a senior portfolio manager at Habinger Registered Investment Advisor, managing sector asset allocation and strategy for high net worth client portfolios. Early in his career, he spent over a decade at Sheffers Investment Research. His research and market analysts utilized technical, fundamental, and sentiment methodologies, with a focus on market expectations and advanced option strategies. During his tenure there, he was the company's primary spokesman and was widely quoted in the national media outlets, including appearances in business television and radio programs such as CNBC, Bloomberg TV, and Fox Business. Mr. Dietrich earned his Charter Market Technician designation, a BS in Finance from Xavier University, and an MBA from Miami University. He also holds his FINRA Series 7 and Series 66 through LPL Financial. You're up, Ryan.
All right. Thank you, Tim. Appreciate that. So first off, I'm honored and delighted to be here for today's webinar to discuss what LPL Research sees happening the rest of 2018. So we'll get right to it. Let's go to the outlook slide here. As you can see here, we have Midyear Outlook 2018, the Plot Thickens. I want to hit rewind just for a second. The reason we're calling this the Plot Thickens, we're kind of building on our theme for 2018, our 2018 outlook that came out late last year. The overall themes there, you think about what's happened since the financial crisis. Monetary policy, that's the Fed, has really driven things. They've obviously increased their balance sheet significantly, kept interest rates, what you could argue, lower than they should have. They've outright said this. And that created a bull market in stocks, but did it really help the overall economy? That can be, this has been one of the weaker recoveries ever after a recession. But what we're really encouraged by is coming into 2018, we saw the government kind of using a different side of the toolbox, and that is fiscal policy, whether it be tax reform, whether that be infrastructure spending, deregulation. And some of those things have taken place, specifically this year, obviously the tax reform. And that's kind of where we think, yes, this is a 9-year-old economic cycle. It's old by any definition, the second oldest recovery going back to World War II. But now we're starting to use fiscal policy. And we think that could be a major, major positive. And so far this year, we've seen that with stocks doing well. The bull market continues to look strong to us. The economy looks good. And that brings us now to the 2018 outlook that we're talking about, the Plot Thickens. Now, here's some just high-level things on what we see happening the rest of 2018. Let's start with stocks. We are still expecting stocks to gain 10% for the year. That's on a total return basis on the S&P 500. As of the time of this recording, S&P is up about 6% for the year, but you have to remember, NASDAQ's up about 13% or so. Small caps are up about 10%. So there are definitely a lot of pockets of opportunity, and we're going to get into all of those. But we still think in the end, the S&P can very well be up 10% or more, being led by strong earnings as probably the main driver out there, along with the benefits of fiscal policy. The economy, we're looking for it to be up as much as 3% for the year. Interestingly, the economy over the last, really since the financial crisis, has not had a single year where the average GDP was up 3%. Longest streak going back to data. Now, how they get data back this far, I don't know, but data back to the Civil War. This is a long streak without a 3% GDP print. We think the economy can definitely gain 3% this year thanks to the combination of tax cuts, new government spending package, and then the financial deregulation that we're seeing for continued growth. And lastly, on the bond side of things, we're looking for flat to single-digit bonds. Overall, economic growth continues to improve, which has brought with it higher interest rates. And obviously, as we know, rates are inversely related to bond prices. So higher rates normally will be a hindrance to bonds. And we've seen that so far this year with flattish bond returns across the fixed income world. And we think that very well could continue. Now let's go to the next slide here, and we're going to get into kind of what we see with LPL research, what we like. Now, as you can see on the screen here, we'll start with what we like. Small caps. We came into this year liking small caps, and we continue to like small cap stocks. And really, again, they pay about 6 to 8% higher corporate tax rate than large caps do. So right away, that corporate tax change that we've had is a big beneficial tailwind for small caps. Also, don't forget, small caps sell about 20% of the revenues overseas versus about 45% of the revenue in the S&P 500 comes from overseas. What's that mean? If you have trade tariffs, you have a trade war, that's going to be beneficial because small caps don't sell as much overseas. So that's been a big plus. We continue to like value. Now, something to think about value versus growth. In the second quarter, once again, we did see growth do significantly better than value. And really, so far this year, growth's kind of outperformed value. But history tells us when you have higher rates and a stronger economy, value does better relative than growth. And if we're looking at a really improving, there's potential for a 4% GDP print in the second quarter with the second quarter GDP coming out next week. That's what we're looking for the second half of the year also, strong GDP. So that should be beneficial for value, and we continue to like that area. Cyclical stocks, what are those? Those are financials. Those are technology, industrial, some of those areas that do better when the economy is really moving along. We continue to think cyclical stocks are doing well, should do well also the remainder of 2018. Just a couple more quickly here. Emerging markets. Emerging markets had a really rough second quarter. Why was that? Well, the U.S. dollar was really strong in the second quarter, and historically speaking, emerging markets and U.S. dollar do tend to trade inversely related, and they pulled back. Nonetheless, we still think this pullback would be a nice opportunity as there's growth and really nice valuations when it comes to emerging markets. Fixed income side of things, we like bank loans, which don't tend to be as pressured by higher interest rates, also investment grade corporates. We still stay on the higher end of investment grade corporates there relative to treasuries. Now we still like in the middle here, we still like U.S. stocks. I mentioned earlier we like emerging markets. You can see on the save for later on the right, developed international. Think Europe specifically. We haven't liked Europe for a while. Continues to lag. There's still some growth concerns. There's still some demographic concerns. Brexit is still hovering out there. So overall, we like the U.S. We like emerging markets. We are not as warm and fuzzy over developed international stocks. Mortgage-backed securities and high-yield corporates, also two areas that we do continue to like for some of the models that we run when it comes to fixed income. So let's go to the next chart now. And we're going to talk about the economy and policy here for a minute. So we all know what's been happening really since March 1st, all the concerns over the trade wars and arguing back and forth, trying to really, countries are trying to do what's best for them, and it's led to a lot of concern. Now, obviously, so far this year, we did see 2 10% corrections on the S&P 500. We were spoiled, though. We didn't have a single 10% correction all of last year. We didn't have almost a 5% correction for the whole year. What happened in 2017 was so rare. There was a streak of 15 straight months of gains for the S&P 500. It ended in February of this year. So we were spoiled by the fact that there wasn't any volatility. Now, we think volatility is perfectly normal. In fact, as we go into the rest of 2017, more volatility is definitely one of the overall themes that we have 3 major themes: policy, peaks, and volatility. And volatility is one of them, and we continue to think as the business cycle ages, more volatility makes a lot of sense. But getting to the chart here now, fiscal policy. As you can see here, we've done the research, and we've seen that the negatives from the tariffs, as you can see here, are potentially $120 billion. So that's as we have now. Now, just because there's been tariffs that have been threatened, that doesn't mean they've been released officially either. But at the same time, all that we've heard so far, all those negatives, if they all were to take place, could be a negative $120 billion. The positive side of things, fiscal policy. tax cuts, government spending specifically, a combination of positive $350 billion. So you can see there's still significantly more positives, in our opinion, from the fiscal policy than the tariffs. Now, we're not minimizing the tariffs. We understand if an all-out trade war takes place, there are really no winners, and that can be a significant negative. We've written extensively on this, why we do not expect that to be the case. And at the same time, the positives from fiscal policy should continue to win out, and that's exactly kind of what we're looking for here. Now, on the next slide, we're going to talk about global growth. And I kind of laid this out earlier, but you can see here. So we're looking for upward to 3% GDP growth in the United States. That's on the right under 2018 LPL estimates. Developed ex-US, again, think that's really Japan and Europe. Now, we're not as optimistic on that area, and one of the main reasons there's not as much growth, right? 2.1% is what we're looking for in that area. Whereas emerging markets on the other side, nearly 5% growth. And here's a neat stat that I heard that I always remember when it comes to emerging markets. There are going to be 1 billion smartphones sold in 2018 globally. 60% of those smartphones are going to be sold in emerging markets. There is significant growth potential in emerging markets. Now, by nature, they're also riskier. Just over the past, like I mentioned, in the second quarter, emerging markets had a really big pullback, and there's some concerns in the currency markets. Just by nature, the emerging markets are a little riskier, but still we think those underlying fundamentals, earnings, and valuations are just very positive, and we still like that area. Now, on the inflation front and unemployment, both of those continue to be positive. Inflation overall, it's trickling higher. It's not a major concern of ours right now. If you look back in history, when bull markets peak, you tend to see 4% year-over-year earnings growth right ahead of the last 3 recessions. Well, we're not even over 3% currently, and some of the other inflation data that we see, it's trickling higher, but there's still not the major worries about inflation. And overall, with low-ish inflation, a very strong employment backdrop, those are 2 positives on the economic front that suggest the economy should continue to do quite well. On to the next slide. As I mentioned, we have 3 big themes: policy, peaks, and volatility. Now, I talked about policy. I talked to why we think there's more volatility coming. Let's talk about peaks for a second. We do admit there have been some potential major peaks in various economic data, one of them being manufacturing. Manufacturing had a very, very high print back in March. And the question became, if manufacturing just peaked, what does that mean for markets and the economy, for that matter? And again, when I say manufacturing, we're looking at the ISM manufacturing data. And if it were to have peaked earlier this year in the first quarter, can stocks keep going higher? And can the economy keep doing better? Well, as you can see here, we look back at, the last 5 recessions. And sure enough, on average, there's nearly 50 months of continued gains before the official start of a recession after the ISM peaked. As you can see on the right, cumulative performance, more often than not, you're going to see significant gains as well. So just because manufacturing very well could have peaked here, that is not necessarily the major concern that a lot of the media and people make it sound like. And again, there are some other peaks that are potentially out there. Consumer confidence very well could be the peak. Earnings, which I'm going to talk about here in a little bit when I talk about stocks, earnings on a year-over-year basis very well could have peaked. But the data that we continue to look at, looking back at history, looking at quantified data, do suggest that some of these peaks, of course, this suggests you're later in the cycle. We are aware of that. But it also suggests there still could be several years left of economic growth and potentially higher stock prices. Let's go to the next slide here. We're going to talk about bonds and fixed income for a minute. Overall, like I kind of laid out, we're looking for higher interest rates. We wrote that at the start of the year in our 2018 outlook. Well, we had some significantly higher moves in interest rates across the board this year, and that kind of pressured overall bonds, and that's really what we expected. Is we expected bonds to be flat to a relative, slightly higher this year. But what's been happening, though, in the yield curve, if you've watched TV, people love to talk about the yield curve. Keep it simple. The yield curve looks at various spreads on different maturities when it comes to fixed income, and when there's an inverted yield curve. And again, keep it simple. 9 of the last 9 recessions took place ahead of an inverted yield curve. The San Francisco Fed found only once was there an inverted yield curve that did not lead to a recession that was in the mid-60s. Bottom line, it's a potential major warning sign. Now, take note, the yield curve as it sits right now is flat. It is not inverted. But we still took a look, and we found, as this chart shows, when the yield curve is flattening like it is right now, which again is some people say is a warning sign about the economy, but the data as we're showing here, this is another one of those, the peaks that we're talking about potentially. There's still a long way of growth. As we show here, you can have about 2 years worth of growth once the yield curve begins to flatten like it has currently. And there can be significant also market returns, as we show there, up almost 67% on average for the S&P 500 once the yield curve starts to flatten before it gets to inversion. And then even after it inverts, and we actually wrote about this on our blog, lplresearch.com, just this week, so I've got the data here. I took a look after the yield curve inverts. It takes about 19 months before the S&P 500 even peaks, and S&P gains on average of over 20%. So again, should the yield curve invert sometime, potentially later this year, even in the next year, that's a concern, but it's not the end-all be-all. Now, our company stance is this, LPL Research stance is this: we do not expect an inverted yield curve. We still see many positives on the economy. We think the yield curve very well could just stay flat. In the mid-90s, the yield curve stayed flattish without inverting for upwards of 3 to 4 years with some significant gains. We think we potentially could have another scenario like that. Let's go to the next chart now. And again, we're talking about bonds. So if we think rates are going to go higher, that should pressure bonds. And what this shows here is how sensitive the various groups in fixed income are to potentially higher trending rates and how well they do, how often the asset class outperforms the broader bond market. And as you can see here on the left side, treasuries, investment grade corporates, those tend to do quite poorly when interest rates go higher. Whereas on the right, you have mortgage-backed securities and high yield that tend to do quite well in the face of higher rates. So those are kind of those areas that we would think if rates continue to go higher like we expect, that those areas should do a little bit better relative to other areas of fixed income. Let's talk about equities now. The next chart. Midterm years can be more volatile. So obviously equities are an important part of any portfolio. And again, with a 9-year bull market, this is actually, I think it's in about 2 months, will become the longest bull market ever. So clearly, right there, it perks people's interest, and you wonder how much more could be left in the tank. Well, hopefully, as we've just laid out, we do think the economy continues to be strong. If the economy is strong, more often than not, you're going to have continued equity gains. But something to be aware of, this is a midterm election year. Now, what happens throughout history, obviously, one party wins the election, then they have a midterm election 2 years later, and that party usually loses seats in the House and in the Senate. And there can be a lot of uncertainty as to exactly what will happen when those seats are lost. And this is what this chart shows. Out of the 4-year presidential cycle, the midterm election year is going to have the largest pullback on average, about 17% on average. So the fact we had 2 10% corrections already this year on the S&P, potentially we could have another one as we reach the troublesome August, September, October period, have a midterm election. We wouldn't be surprised by that if it were to happen. Volatility and pullbacks are normal midterm election years. The good news, as you can see here, if you hold those lows and wait 12 months, you're up about 30%, over 30% on average after after the lows of a midterm year. And every single time, 12 months later, going back to the mid-40s, the S&P 500 has been higher a year after the midterm year lows. So those are things to be aware of. And LPL Research, we wrote extensively why we thought early February was probably the lows for the year. And it's not saying this too absurd now, but when we were writing about it and talking about it back in March, and so as we carved out this bottom, it wasn't quite as popular as a call, but we do think those February lows were probably the lows for the year. And, there's continued volatility can be in play, but still there's a lot more upside to the markets here, we think, in our opinion, than the downside. But still be aware, midterm years can be those tricky years. On to the next chart, we'll talk about earnings. What drive long-term stock gains? It's earnings. We know that. In 2014, 15, 16, earnings really didn't do anything. If you think back 2015, 16, yes, the overall upward trend in the bull market was in play, but we also had about a 14-month period without new highs on the S&P. In 2015, the S&P 500 was just barely positive on a total return basis. So we had some frustrations and some sideways choppy market in the face of a bigger overall bull market. But what's different now is earnings are accelerating. Last year, earnings gained about 13% for the year on the S&P 500. This year, they're expected to gain as much as 20%. We just had 24% approximately year-over-year earnings growth in the first quarter. The second quarter earnings are kicking off right now. Financials always start things, retailers always end it. Financials, some of the big banks have had some really good earnings so far. It's early, but definitely we think this could be another positive earnings season with earnings up again, up over 20% year over year. That'd be 2 quarters in a row. We haven't seen anything like that since right after the financial crisis coming off the lows. So those are positives, but we're going to get back to that theme we have of peaks. If earnings just peaked year over year in the first quarter at over 25% for the year in the first quarter earnings, they very well could have, okay? And if that happened, what does that mean? There's been a lot of talk in the media about earnings peaking. What does it mean? Well, as we show here, we looked at all the previous times that earnings peaked out and how long before a recession started and the potential gains that still took place. As you can see here, nearly 50 months on average after earnings peaked. And the S&P gains an average of 60%. We'd probably be more in line with that median return right beneath it of 30%. Nonetheless, if there's still 3 to 4 years left and those type of gains, we think most people will probably be quite happy with those returns. So at this time, just a couple other closing comments. This year has been, even though it feels like it's been different, it really hasn't been. Most years have a correction of about 14% on average. You do tend to see higher prices for the year when there is no recession more often than not. And once again, we see very little chance of a recession this year when it comes to equities. And we continue to be a buyer. We like those small caps and emerging markets to continue to lead us. And, one of the big themes and questions is how there's just a few stocks leading. Only a couple stocks going up. Is that really why, is the market just ready to fall over because only a few of the big FANG stocks are leading things? Well, fortunately, we don't think that's the case. When you look at the small caps and mid caps, there are still a lot of stocks participating. All 11 sectors of the S&P 500 should have positive year-over-year earnings growth. Yes, technology has clearly been leading once again, though we really do think there's a good underlying pinning with a lot of various small stocks that are participating. And in the end, the S&P should probably follow small caps lead and get to that positive 10% for the year level, which would be a really nice year after gaining over 20% last year. So at this time, we really hope you've enjoyed taking a look back at what's happened so far in 2018 and looking forward for the next 6 months as to what LPL Research thinks could be in store for investments and the economy. So Tim, I'm going to turn it right back to you. Thank you for the opportunity today.
Thank you, Ryan, for your thoughts on the current market environment. As a reminder, if you have any questions, please contact us. We would like to hear some feedback to help us improve the format of these calls. Also, if you know of anyone who would be interested in hearing our market update, you can forward this email to them. Thank you for your continued confidence.